Diversification alone does not guarantee financial success. It's easier to fool people than convince them they fooled. That was Mark Twain, of course. So let's kind of get into it. Do you go to cash? And I know that, Sue's the reason I'm picking you. I think you had called when we talked about that. And I understand that. I understand what side of the aisle you are on. It's funny because I have my right-wing clients that wanted to be in cash under Biden, and I have my left-wing clients that want to be in cash under Trump. It's like, okay. But cash is not a strategy. You know, if you look at the real numbers of the CPI, if you look at the real numbers, they keep changing the formula. In 1980, if you look at the formula for the CPI, inflation would be 12% today. But it's not. They say it's 2.7. So they keep adjusting the formula. Why? Because they index Social Security, which is a huge thing, to inflation. So let's keep that number normalized. But if inflation is really 12%, so a good friend of mine comes in, his wife is in cash, and he basically said, we're trying to get her invested. And she goes, Dom, honestly, I just need $2,000 a month for the rest of my life. And that's what I'm getting right now for my money in a money market. Her life savings. She's retired, he's retired. And I said to her, I said, you know what? With inflation, your money in 12 years is going to be buying you $500 a month. So you're going to be homeless. Didn't register, did it? Okay. Anyway, here's my concept. I'll get into my concept. Now, what if we don't make a bet? What if we don't care? What if we don't put money on the table, Marlon, we can't lose, right? If we don't put money on the table, we can't lose. If we don't take a view. And what does Warren Buffett say? The secret to growing wealth is protect your principal and play with your interests. Okay, so I follow Warren's strategy. In fact, here's one of my mentors, Dr. Nassim Taleb. If you call my office and you get put on hold, you hear him babbling. And he's the one that came up this quote, which I use. If you don't hedge, you shouldn't be invested. I love that quote. Because 100% of the people in this room are hedged. 100%. Nobody in this room is not hedged. Nobody. That's got money with me. So the bottom line is, I can sleep at night because I am hedged. So a lot of people say to me, well, what's a hedge? Is it like a hedge fund? Well, let's talk about what a hedge is. Think about a parachute on a diversified portfolio. Think about if you live by a river, you better buy insurance, right? The idea of hedging is simple. If the market goes down, what if I can cut off that left tail? What if I can get rid of that downside? That's what hedging is. I'm buying a sort of insurance that Warren Buffett uses, that Nassim Taleb uses. Nassim Taleb, when the markets crashed 35% in March of 2020, he was up 2,100% in his hedge because that hedge kicked in and it defrayed his loss. I've stole some of his strategies right from his book. The safest bet is no bet at all, but if you're going to bet, let's hedge it. Now, Dick, this is Google. Okay, you can own Google outright, or I can own Google and hedge it. Well, what would you rather own, the blue line or the red line? Because now that should go up to there. If I'm capturing 100% of the upside, but I could be hedged on the downside, I'm creating asymmetry. And that's really what we're talking about. We run two hedge strategies at our firm. We run two. We run a dynamic hedge, and I run a static hedge. Now, my dynamic hedge is my mutual fund, and my mutual fund works on a simple premise that I have what we call convexity. So, bottom line is what we basically have is hedges that as the market goes down, we participate less, and when the market's going up, we participate more. So, let me give you an example. When the market crashed on Friday with the job numbers, my participation against my benchmark, the S&P, was 75 at the beginning of the day. I was capturing only 50% by the end of the day. And when the market bounced on Monday, I went from 50% participation. That means I'm only making half or losing half to 75. So my portfolio floats automatically based on my hedge positions. So I want to be less in the market if it's crashing, and I want to be more in the market if it's running. And that's how it's dynamic, and it works. We've averaged about 10% a year, so your money's doubling every 7 years. I had a friend of mine call me up, and she said, Dom, I just quit my job. I started a new job, and I've got some money I need to roll to you, but it's not a lot of money. Now, Natalie is 41 years old. And I said, Nat, how much? She said $150,000. I said, well, Natalie, hold on a second. When are you going to retire? Oh, mid-60s. I said, okay, let's do the math. At 10% a year, your money's going to double 3 times in 21 years. 300, 100, 300, 600, 1.2 million. So don't tell me 150,000 at 41 years old is not a lot of money. It is. That's going to really grow if we can get that compounding return and we can cut off those losses. Because the losses is what causes, when you go backwards, you got to do more to go forward. So here's the concept. This is just a P&L of a stock. If the market goes down, you're losing money, that's price. If the market goes up, you're making money. So what we do is we cut off the left tail. And we say, okay, what if I can eliminate the downside, and what if I can give up a little bit of upside? So now you're saying, well, wait a minute, you're going to give me 75% of the upside but no downside. I don't know. Is that better than being 100% long? Well, let's kind of take a look. Market's down 20, I'm flat. Market's up 20, I'm up 15. Oh, that sounds pretty good. Well, let's look at how it has done over the long term. If I capture 75% of the market, right, I'm going to average 9.25 over the last 20 plus years. Well, the bottom line is that the idea is this. If I don't lose when the market's down, I win in the end. In fact, here, let's just look at this. If the market's up 10 and I'm up 7, and then the market goes down and I lock in that return, I might be flat in year 2, but I'm not losing. So if I have a sideways market, in the end, I'm going to win. And that's the idea, is Warren Buffett says you don't need to win. Just don't lose. Not losing is the secret. Now, let me ask you a question. This is always a fun one. What was the worst time, Dick? What was the worst time you could have ever invested in the history of the stock market? Just take a guess. The worst time. You said, I'm going to retire on this day. What would have been the worst day you could have retired?
The worst day?
Worst time to retire.
Probably during the recession of
the Great Depression, exactly. So here it is. Dick decides to retire in 1929. October 29, he said he's going to travel the world. And so you take your $1 million. I know you're worth more than $1 million, but you take your $1 million, you retire, and guess what? The market shits, excuse my vernacular, for 4 years. Your million is down to 199,000. Okay, you're looking for a window. At that point, pretty much, you're not happy. Now, what you did say to me is what Susan said. Susan said, Tom, I just want to go to cash. Well, Susan, you'd have been really good, because if you went to cash, you'd have been up 121,000 when the market was down on 199. So you'd have been like, woo, high five. But my argument is, even though my strategy would have not made money in 4 years, because I'd have been flat, 1 year, because 75% of 66% is 56%. In 1 year, I'm beating that 4-year compounded return on, and I'm assuming you're making 5% on your CD or your money market. But look at that difference. Over 7 years, you're talking about $500,000. That's quite a bit of money. Veronica, that's quite a bit of money, and that's retirement. That $500,000 is going to change your retirement quite a bit. So that's what I'm saying, is that if we can just hedge and cut off that tail, this is, I don't understand how everybody, it's not do money managers do this. Why doesn't everybody do this? I don't know. Well, I do know. I have a reason that not losing is winning. And that's really what the point I'm trying to make. If you lose 50% of your money, you're going to make 100% to get back to break even. And I know you guys at kind of my lectures have heard this 5 trillion times. But if you lose 60% of your money, you got to make 150% to get back to break even. So why doesn't everybody hedge? Well, first of all, I think diversification is very good for the banks. I remember as a young person, I graduated from CU in Boulder, and I went to New York, and I had my best polyester suit on, and I'm walking up and down Wall Street, and they're saying, son, do you have sales experience? I'm like, well, why? I mean, I have finance experience. Well, they said Wall Street is commission driven from one end to the other, and you got to sell products that we tell you to buy and sell. So yes, it's just a commodities-driven industry. Hedging is very complicated. Most people that trade options usually blow up because it is very complicated. 2 universities asked me to teach because their PhDs don't understand it. Because if you didn't get a PhD in derivatives, you ain't gonna be able to teach it. Trust me. If I didn't do this every day, I wouldn't be able to do it because I do it every day. If I stopped for a year, I'd be like, oh, I got to think about that. Every client requires a custom hedge. We don't shop for clients. Every client in here has a custom hedge. Every client in here, except if you're in my mutual fund, which is, liquid and has some value there. But it's tremendous amount of work. Vinny knows that. I beat him up every day. He bitches at me privately. God damn you, Dom. Anyway, and there are competitions. They have been able to package my concepts. And there are companies that are doing it. SIBO Vest, Allianz, Innovator. But the problem is, it's sort of like the index annuities. They're taking away all the value. Well, I'm going to give you 7.5% max on any 1 year. Ours are unlimited. So if I look at comparing markets down 20, that's the most popular one right there. They're flat, I'm flat, but if the market's up 20, they're only up 7.5, I'm up 15. And here's what's the rub is. They're charging you 75, the expense ratio is 75 basis points. And then they're charging you a management fee because the advisor's not working for free. He's charging you 1.5, plus 75. I'm not charging any management fees because I'm building them in your account. That's why so many people in this room are like, what the heck am I looking at? They see bonds, they see options. It's like, I don't understand this. So they call up Mallory, and then Mallory's been with me long enough, she can answer them, doesn't even have to get me involved. But anyway, good job, Mel. Anyway, here's the concept, and then we'll eat. So think about this for a second. Think about, I got a pie chart. So I'm long the S&P. If it goes up, I make. If it goes down, I make. Lose. Then I have maybe EFA, an ETF. Then maybe have FXI. So these are different, and maybe you have some bonds. This is a diversified portfolio. But what if I could do, okay, I own S&P, so I'm going to hedge it. I own Europe, I'm going to hedge it. I own China, I'm going to hedge it. And Martin, quite frankly, since COVID, the S&P has been the best horse. I mean, the U.S. markets have exploded, the other markets have not. But this year alone, China's up 25%, Europe's up 17%, we're up 7%. So as your notes come due, guess what I'm doing? I'm spreading that out. Right, Vinny? We're buying EFA and we're hedging it. We're buying FXI and we're hedging it. How is this not a better way to run a diversified portfolio? It is. Absolutely it is. Now, I do want to make a point only because I get a lot of questions on this. There's a difference between the current value and the mark-to-market value. And the reason I'm bringing this up is a client emailed me last week and they said, can you please tell me how I'm doing compared to the S&P? Well, I had to explain to her that actually she has not 75, her participation is 82. It all depends on where I get you in and what interest rates are. So she's 82. I said, but let's use 75. If the market's up 10, you should be up 7.5. But her statement only said 3.75. I said there's a reason for that. First of all, there's something called a delta lag. Now, I'm not going to get into what a delta lag is, but all that means is if my delta is 50, I'm only showing you 50% of the gain. So your unrealized gain is 7.5. Your realized gain is 3.5. So that's why you don't really, if I build you a 1-year note, you kind of want to hold it till it matures because it's going to snap. Because that delta is going to go from 50 to 70 to 80 to 100. You're capturing 100% of that move. But because we're buying at the money options, and also the debt doesn't mature to par until it does build. So when you look at your statement, don't freak. I think that's why Joe fired me, because he had a great structure, Mark, but he didn't understand that he had a lag. He didn't call me. And he said, and I would explain to him, no, your unrealized gain. So a lot of clients will call me and say, Dom, what is my unrealized gain? And I'll send them an email saying, you're up X. If the market didn't move, that 375 would snap to 7.5. So I did want to bring that up because I do get a lot of questions on that. Okay. And then also remember, as a money management firm, we do complete services. We do wills, trusts. If I'm managing your money, we do estate planning. We could do real estate. We do nursing home, help you find. So we really do more than just run money. I've been doing this a long, long time. I've got a great team, and we're really good at it. I've worked with a lot of attorneys. I've worked with a lot of realtors. So definitely, if you've got a need, call me first. Say, hey, Dom, I'm looking for independent living. I had that yesterday. Okay, let's get my team on it. I've helped a lot of my clients go into independent living. My average client, I hate to say it, is a little older. They've gotten older.